So what is investing? You probably know what it is. I know you've probably got some knowledge of it, but there's some things you'll probably not be aware of. Certainly if you're brand new, certainly what you can do, the different types of markets and stuff like that, okay? So we'll keep it super simple, and it's important to note a few of these. So essentially investing is about putting money away or into something for a long period of time to enable it to work. Put your pennies to work, as they would say. This could be a project, a share, a property. It could be all kinds of elements that could be utilized to generate positive returns. That is the ultimate game. Whether to live off it, whether to, just get appreciation, many different factors, okay? Investing is also very, very different from saving, as you could lose capital and obviously projects could fail. A lot of people look at savings and don't risk. Everyone has a different risk appetite. Some people will put loads of money in the bank and not do anything with it, but ultimately inflation is kind of killing you. In my opinion, you've got to make your money work, whether you are putting in certain vehicles, which we will talk about very, very soon. You have different types of risk. As I just kind of alluded to, people will save, no risk appetite at all. But there's different types of investing that has different risk appetites to enable you to do better. So whether that is into a pension fund, an ISA fund, or stock shares, whatever they may be, right? You can do this yourself, or you can employ the services of a professional money manager. There's a lot of things like robo-investing, there's like stocks and shares ISAs, which have big funds, which some companies will move the money around for you, or you can go and seek a professional advisor and they will manage your money for you with fees attached to them, obviously. Most common investments are the likes of stocks and shares, bonds, index funds, whether they're like the S&P 500, the NASDAQ, real estate, property, etc. Collection art, so art, collection cars, etc. And obviously cryptocurrency. So going on to returns. I've already mentioned it, but you could make losses on any investment. You could also use these as a tax loss for any future potential gains. So for example, if you made a loss in one financial year, you can utilize those capital gains or that loss of capital gains and utilize it for when you do actually make some gains, which is quite useful. The simple returns that you can have on any asset, mainly using this as an example here. So obviously buy one share of whatever stock you've got at 310 and sold it 6 months later for $462 or $460.20, sorry. Your return would be 48%. If you're utilizing like a load of different portfolio management, or if you're utilizing like a trading view, you can calculate this very, very easily. Throughout this course, we will go through how to manage your money, how to manage it yourself, essentially, so you can see what your returns are. Because ultimately, if your maths isn't your strong point like myself, it makes sense. Some investments have dividends. This is important to note. This could also throw out certain elements of, returns and the cycle returns and stuff like that over a course of time. And the most important thing, some returns can be more complex. Certainly with property, there may be further taxes to take on board instead of capital gains tax, such as stamp duty and other bits and pieces that you may have forgotten about. So make sure you do those calculations first. What is a bull market? Now, this is where things start to ramp up a little bit, but ultimately pretty straightforward in the eyes of how markets work. In simple terms, it is when prices are rising and expected to rise further. This term can be applied to any investment. So a bullish period for anything, whether that is in the stock market, whether that is in crypto, property, is because prices are much higher than they were. These are determined by higher highs and ultimately higher lows in an upward bullish trend. So if you're looking at trends, if you're looking at how oscillator data goes up, you'll see that prices have gone from say $1 up to say $10 in a period of 7 years. That is a bull market. Often leads to new people coming into the market and making the prices go even higher due to the emotional hype generated. Feel free to pause this and just, put your hand up if this was you, because a vast amount of people come into these financial markets in a bull market, usually. And it's often where the most hurt is. I often say this, that bulls will get you destroyed, but bears will keep you hungry, right? It's just the way it is. It's just because if you buy at the wrong time on hype, you're going to get some realized losses very, very quickly. And sometimes in a bull market, when the market does pull back, it's quite aggressive. And if you're new, you're going to sell, and it's not good. And it will continue going higher. It's not nice. We've also seen in the past that big fund managers can over risk with margin, with leverage, with multiples on their orders, thinking anything they'd buy will continue to go up. This has led to like margin calls and liquidations in their funds. We've seen it quite a lot in crypto. We've seen it quite a lot in the stock market in the past, in economic crisis periods where mortgages have gone bust. Banks go underwater. It's not great. So big problem. And finally, the most common tactic for a bull market buyer is usually buying and hold. Take this with a pinch of salt though, right? I don't mean to offend you, but most people forget to sell in these market conditions, and that is where the world of pain happens, because you could be sat there buying a stock at like $300, and all of a sudden in a bear market, which we're going to come on to in a second, it's worth $90 or something. It's not good for the pocket. It hurts. Bear markets. In simple terms, it's the opposite to what I've just said. Prices are falling due to lack of interest, or after some extreme profit taken due to an extended run, or policy changes in terms of quantitative easing, quantitative tightening, all kinds of stuff like that, which we will come on to later on. This is where we will get lower highs and lower lows, creating a downtrend. So when you see oscillating data, as I say, go down, say you could have bought an asset at $300, it's now worth $50, whatever. Ooh, over a period of time it hurts. And if you bought that level at $300 and you're sitting there with 70, 80% of your portfolio completely destroyed, you're going to feel it. Opposite to a bull market is, people are moving away from it. People don't want to invest anymore. There's negative investor sentiment. People do not want to look at their portfolios due to that price point. It means lack of interest, which is a good thing if you understand the mentality of how to make money in the stock market or in an investment vehicle, whether that is in an index fund, cryptocurrency, or even property, buying up the lows, right? Because the real offer is money is made in the bear market. Because who doesn't want to buy low price stocks? Who doesn't want to buy a low valuation of an index fund? Who doesn't want to buy low Bitcoin cryptocurrency prices, right? The speculation on future price analysis and predictions are absent because the hype isn't there. The idiots aren't around. And I know that is quite offensive, but there's a lot of people who are making a brand or a following on stock market speculation in a bull market. You don't see them in a bear market, which is always a big red flag. To capitalize in a bear market, you need to take profit in a bull market or have some sort of capital available to you to enable you to reintroduce that capital at those low levels. If you don't have capital, you're never going to make money, are you? Size is a big thing. Keep your money, perfectly kind of poised to go into the market, because ultimately, if you can buy more units of an asset at the lows, you're going to do okay. And finally, be careful with the bear market rallies. These can lead to heightened emotion, especially if you've been starved of some price appreciation. Certainly if you've been sitting on losses for a long time and all of a sudden you got green candle, green candle, green candle, they could take your head off if you get it wrong.